Hi, everyone. Thanks for spending an hour or so with me today. We're going to talk about solo 401k plan distributions and loan rules in depth. This is an important presentation because it's something that a lot of people don't realize about the limited access you actually have to your 401k money. And there's a reason for it, obviously. So we'll talk about all the rules, how you can tap into your 401k if you need to, whether it's through a hardship, whether through a loan, whether it's through a substantially equal periodic payment method, or maybe you're just not going to be able to get any money out of your plan, and we'll talk about that. So we'll start in a couple minutes. I'm just gonna give people a chance to log on and join. But there's a lot of demand for this because I think there's a lot of questions about how to actually get money out of your 401k, especially if you're under 59 and a half. And that's where all these rules come into play, i.e. hardships, in-plan distributions, being over the age of 55, what your options are, the loan, how can you tap in and get some of that cash to pay for personal expenses that you would like to use for. So it's I'm going to spend the next 30 or 40 minutes going through some of the rules, and obviously if anyone has questions, just type them in and I'll get to them if I can. If not, I will address them separately, either through a different webinar or through direct email to the individual who left question. So thanks again, everyone, for spending some time with me on a Tuesday. I know people are busy, work, vacation, summer, so I appreciate it. So let's get started. Again, the topic is solo 401k plan distributions and loan rules in depth. Adam Bergman, IRA Financial. So let's start real quick. If you're listening or watching this, you probably have a 401k, a solo 401k to be exact. So let's just briefly talk about a solo 401k is a 401k defined contribution plan specifically designed for someone who's self-employed. It's also called a one participant plan, self-employed 401k plan, individual 401k plan. It basically means a 401k plan that only applies to the owners, and their spouses. So there cannot be any non-owner employees that work over 1,000 hours. If you have a situation where you have a non-owner employee that works more than 1,000 hours, you're not going to be eligible for the solo 401k. You will have to set up a 401k, which is subject to ERISA and plan testing rules. So people like the solo 401k because you're not subject to ERISA, so you have a lot more freedom. And since it's generally a one-owner participant plan, you have more power over investments. You don't have to deal with fiduciary risks and also making, for example, profit-sharing contributions to other employees. So the one other thing I want to mention is if you have independent contractors, 1099s, you can have 50, 100, 200 1099s. If they're not employees and you're the sole owner or there's only owners involved, you still can have an owner-only solo 401k. They got solo 401k became really popular after 2001, EGTRA, Economic Growth Tax Relief Reconciliation Act, the Jobs Act after 9/11, President Bush signed it into law. There was also provisions that added some saving features to the solo K that gave it more teeth, more power. For example, it added a Roth component, it added the deferral component, and the loan component, which gave the solo 401k much of the same powers as a regular defined contribution ERISA 401k, but without the ERISA requirements because there's no non-owner employees. So since 2001, solo's become the most popular and robust plan for the self-employed because it has all these great features of a regular 401k, but you don't have the added burdens of administration and ERISA. Okay, eligibility, I talked about that. It could be any business, sole proprietorship, LLC, corporation, partnership. The key is you just need to have a business. You can't have any full-time employees over 1,000 hours. So let's get into real quick the contribution rules. As a quick recap to my prior presentation. In 2019, there's two components. There's the employee deferral and the employer contribution side. On the employee deferral, that's optional, 100% optional. it's $19,000 if you're under 50, $25,000 if you're over 50, dollar for dollar. So if you made $21,000, you can defer the full 19. If you made 26, you can pretty much defer the full 25 if you're over 50. And that could be in pre-tax or Roth, so long as your plan allows for it. The employer profit sharing, also called, it's an employer option. So if the employer does it for one person, it does it for all participants, all owners, and it's 20% of your compensation, or 25% in the case of a CS or partnership in the W-2 world. So for example, if someone made $100,000 and they're under 50, they can do 19 plus either 20% or 25% of 100, depending on how the entity is structured. If it's a C Corp, it would be 25% of the 100,000 W-2, giving them 25 plus 19 on the deferral. The profit sharing must be pre-tax. Okay, the entity gets a deduction for it. You can convert it to Roth so long as your plan has a Roth component. And then once you combine the employee and the employer, it cannot be more than $56,000 if you're under 50 and $62,000 if you're over 50, and that's the aggregate cap. The profit sharing is per plan. The employee deferral is per individual. So once you hit your 19 or 25,000, whether you have 1 or 10 plans, you're done. But if you have, for example, if you work at Apple, but you also have your side business, and Apple has allowed you to max out the employer side and get you to 56 or 62, you can actually go above that if you have another side business. So employer is per plan, employee is per individual. So let's get to the distribution. We talked about eligibility, talked about contributions. How the hell do you get money out of your plan? So number one, big picture, is the IRS, Department of Labor, Congress, when they developed these 401ks, and the concept of deferral and savings, which was embedded in ERISA in the early 70s. The idea is we want to force people to save. We want to make it hard to pull money out of the plan. That's really the core foundation of the retirement system is, hey, we want to incentivize saving. We want to incentivize saving through deferral and or tax deductions in the case of a pre-tax 401k, but we want to de-incentivize pulling the money out by making certain rules. And one of the rules are pre-tax penalties, extra 10% in the case of an IRA, or in the 401k world, essentially a prohibition from pulling the money out unless there's a triggering event. And we'll talk about what a planned triggering event is. So hard to believe. A lot of people say, I don't understand. I'm 45 years old. I need some money. I want to buy a car or I want to go on vacation. It's my money. I look at it every month on my statement. It's from my salary. Why can't I touch it? I'll pay a 10% penalty. I don't care. Why can't I touch it? You can't. And we'll see how you can. And if you fit into either a hardship, a substantial equal periodic 72 elections, or a loan. But other than that, you may not be able to tap into your 401k. Hard to believe, but it's true. Unlike an IRA, which is a totally different retirement account, it's taxed under 408, 401s or 401, different rules. A lot of people think IRAs and 401ks, they're both retirement accounts. They're the same. They're not the same. They have different rules. If you have an IRA, you can tap into the IRA anytime you want. But if you're under 59 and a half, you're going to pay tax plus a 10% early distribution penalty. If you're over 59 and a half, you'll just pay tax. With a 401k, we're going to see you may not be able to tap into your money. So how do you get money out of your plan? Okay, hardship, we'll talk about how you satisfy hardship. Substantial equal periodic payment under 72T or 72. Rollovers, if you're able to get money in and out. And require minimum distributions, which is kind of a force distribution, and also death, right? That's one way you get money out, but that's really not going to help you. And obviously the loan, which we'll talk about it, but the loan is not really a distribution. So what's a triggering rule? The triggering rules are basically the foundation on how to get money out of your 401k. First thing to remember is, as a base rule, if you're under 59 and a half, you can't just pull money out at your convenience, okay? If you're over 59 and a half, you can pull money out anytime you want, okay, pretty much. Almost all plan documents you'll work with will let you do it. Some plan documents, even if you're over 59 and a half, will have limits in terms of how long you have to wait to pull money out, but mostly once you're over 59 and a half, you can tap into the money. It's just when you're before the age of 59 and a half, you have to satisfy generally a hardship or do a substantial equal periodic payment, or if you're over 55, there could be an early, you have the ability to do an early distribution without penalty, or you could do a loan. Those are really the ways to get money out, which we'll tackle in a couple minutes. So the first trigger event is under 59 and a half. You can't do it. Over 59 and a half, you're in. So number one, over 59 and a half, you can touch your money. Number two, you leave your job, right? If you leave your job, you should have access to your money. Maybe, maybe not. Caveat to that, you have to look at your plan documents. The plan document is like the Bible. It controls what you can do. It controls what you're able to do, what you can do without sinning, and what you can't do because God won't let you do. So believe it or not, there are plans that say you leave your job, you still can't touch your money for 30, 60, even up to 12 months. Why? That's the way the employer wanted the plan drafted. The employer controls how the plan gets drafted. For example, the employer can say, I don't want a Roth option. I don't want a loan option. I want to put limits on moving the money out. Some people want to incentivize people to stay, so they make it harder to pull money out. Some people want to have that money in the plan. The main reason why people won't let you touch their money right away before leaving their job is they want to make sure they have everything organized, especially if it's a combined account where it's not an individual account per individual employee. They want to make sure that they have accounted for all the money. There's no loan outstanding or there's no excess distribution that's not accounted for. So they want to make sure they have time to make sure that they're giving you the right amount of money. That's not the norm. 12 months to wait to touch your money after leaving, generally not the norm. Generally, it's 30, 60 days or so, and then you can pull the money out. Sometimes it's quicker. But the second triggering event is leaving your job. So over 59 and a half, you can touch it. Second is leaving your job. Third, the company terminates the plan, right? So either a merger, for example, when US Air merged with American Airlines, we got tons of pilots that had access because there was a merger, there was a triggering event. They were able to tap into some of their money, and they're able to move some of it to an IRA, for example, or take a distribution because of the termination of one or both of those plans. So those are the main triggering events. Those are the easiest ways to get money. If you satisfy generally one of those three, you're going to be able to tap into your 401k. Remember, you don't want to tap in because it's in your interest to keep the money riding in your plan. You benefit from tax deferral or tax-free growth in the case of a Roth. Your money grows, and even as Warren Buffett says, it's the eighth wonder of the world, compounded interest. That's how rich people get richer. That's how wealthy people get wealthier. Let your money work for you without tax. But life happens, things happen, emergencies happen, and we'll talk about hardships and how you may be able to tap into some of your money. So what happens if you don't satisfy the plan triggering rules? Okay, you're 45 years old, 50 years old, 57 years old, 51, 33, what do you do? Okay, number one, you got to look at the hardships, and we'll talk about those. Do you satisfy a hardship? If you do satisfy a hardship, you get access to your money. You still have to pay tax on what you pull out, but no 10% penalty. So that's good. Okay, and we'll talk about the exceptions. If in order to be a hardship, okay, this is important. It has to be immediate and heavy financial need, and the amount must be necessary to satisfy the financial need. The need of the employee includes the need of the employee's spouse or dependent. So you really need to show you need the money. You can't tell your employer, I want to go buy a Mercedes and I need a little bit extra because I can only afford a Lexus, but I need some extra cash for the Mercedes. Not going to fly. It's up to the plan administrator to approve the hardship. And generally, if they get audited, they need to have the documentation to prove to the IRS that they merited or the employee merited taking a hardship. So they do have responsibility to make sure that there's backup for this hardship, and they will ask for documentation. If it's medical, they will ask for a doctor's opinion. If it's financial, they may ask for copies of your financial statements, bank accounts, or even an affidavit to show that you really need this money because they don't want to run afoul to IRS rules. And another point is a distribution is not considered, and this is important, necessary to satisfy an immediate and heavy financial need of an employee if the employee has other resources available to meet the need, including assets of the employee's spouse and minor children. Okay, so if it's available, it's based off facts and circumstances. So you need 50 grand for whatever reason. Your money's tied up in a fund that you can't get access to because there's a 5-year lockup period. That's a fact and circumstances. You may have $200,000 available that you can use, but it's locked in a fund and you can't get it for another 3 years. That's a fact and circumstance the administrator will look at. Okay, so it's really up to the administrator, but you really do need to show the immediate need, and it's the burden's on the employee that needs the money to prove that he or she needs the money. And administrators are, I think they're fair, and they could be tough because they don't want to get in trouble with the IRS or the Department of Labor if there's an issue where they let money out of the plan and it wasn't allowed. So what are the hardship distribution exceptions? Okay, death or disability is one. 55 and over. So if you're over 55 and you are retired or leave your job, that's important. If you're over 55 and you're staying with your job, this hardship won't apply. You can do a substantial equal periodic payment, which we'll talk about, but you can't just pull the money out without penalty. Okay, you have to be 55 and leave your job. And then the substantial equal payment, which is under 72, which IRC section 72, which we'll talk about in a minute. Medical expenses exceeding 7.5% of your adjusted gross income. And you're gonna have to prove, God forbid you need the money to pay for medical. You need to show that, again, it's necessary, you have no other source of payment, and it needs to exceed the 7.5 of your adjusted gross income. And you can do it. You don't have to itemize to claim the exception. So even if you're not itemizing, meaning you're just taking a general standard deduction on your tax return, but your medical need is going to be 7.5% more than your adjusted gross income, and you can prove it, you can get the hardship. So hardship means you can tap into the plan, you pay tax, but not the 10% penalty. Okay, the next one is divorce, separation. You need the money for a divorce or separation based off of a quadra, qualified domestic relation order. You can take the money out without penalty. Home buying exception. You did not own a home in the previous 2 years, but only $10,000 could be used on this hardship. You still have to pay tax, but no 10% penalty. Only 10 grand, which isn't a whole lot for many people, and that number hasn't gone up in a long time. So that's something that could change. But the problem is, again, there's no incentive. The IRS, Congress, Department of Labor, they do not want people taking distributions, even though they're getting the tax on this money, which they do like. Their intent, and I think their goals with the retirement system, is to make sure people are saving, and the incentive is keep this money working for you, compounding interest, eighth wonder of the world. You're going to get wealthier, and we want you to be wealthier because we don't want you to rely on Social Security payments exclusively for your retirement. So they're trying to incentivize us all to save, and pulling money out is not helpful, but they do understand there are hardship reasons for doing so, like medical, like first home buyers, $10,000, education, eviction, foreclosure, separation, divorce. So there are reasons that they feel are justified to pull the money out. And if you basically, what the administrator or the custodian will do is on the 1099-R in a box 7, they'll code it, okay, and that will let the IRS know you took a hardship. You also will report it on your tax return, so it will match up. Again, you're going to need to get this by the plan administrator. They'll have to approve it, and you're going to have to show necessary expense. What's a substantial equal payment? So let's say you don't satisfy a hardship. Okay, you're under 59.5. You don't have a triggering event because you're still at your job. You're over 55, but you're still with the company, so you can't use the early retirement exception. What is a substantial equal payment exception? That means that basically is this. The IRS under 72T will let you take a little bit of money out for basically at least 5 years, or if later, until you turn 59.5. So if you're 54 or 55, you'll do it for 5 years. If you're 40, you can do it until you're 59.5, and then you can get a small amount of money each year that is not subject to penalty. It's still subject to tax, but not 10% penalty. But you can't take whatever you want. It's a system. It's like an RMD. You can take a certain amount each year. It's based on Revenue Ruling 2002-62, And there's three methods that you calculate how much you can take out. There's the requirement and distribution method, amortization method, and the annuitization method. It's basically a small percentage of money each year, kind of like an RMD, and it goes either 5 years or until you turn 59 and a half. But you can't just choose what you want. You got to keep to the formula. You can't just mix and match and say, well, this year I want 2 grand, next year 15. You got to take this set amount and you can't break it. You're locked in, okay, until 59 and a half. So it basically, this is just a little formula here, a little example. If Bob's age 50, he's the owner of an IRA. He wants to take distribution. So he doesn't have a triggering event, under 59 and a half. He's under 55, no hardship. He needs cash. What does he do? He doesn't want to pay the 72 T 10%, so he can sign up for a 72 equal periodic payment. And if he had a $400,000 value, he would take out about 2.9% each year until he's 59 and a half. So not a whole lot of money, but he'll get something that's subject to tax, not the 10% penalty. And if you look at the regulations under Section 401, the Treasury regs, not like anyone's going to look at it, but there's a formula, an example on how you get to the number. We can figure it out for you. There's calculators online that will tell you what your equal periodic payment's worth, how much it's going to give you based off your life expectancy. You can use a variation of expectancy tables, how you're going to do it. So you can use your own life expectancy, and then based off that method, you'll calculate that and multiply that against the value of your account, and then we'll give you how much you can take out each year. But you got to stick to that based off the remaining years under the payment system. Okay, again, that's going to give you the money, but still save you the 10% penalty, but you still got to pay tax. Rollovers, again, you need a triggering event. So even if you say, well, I don't want to take a distribution, I just want to roll it to an IRA, too bad. If you don't have a triggering event, you're under 59 and a half, you're staying with your company, you can't do it, okay? If you don't have a hardship, you can't even touch it. But if you're over 55, okay, and you're going to retire, you can take the money out without 10% penalty, okay? So it depends on your plan docs, but you got to be over 55 and you have to retire. You can't stay with the company. If you're staying with the company, you can't take advantage of the early retirement. It's only if you leave your company and are over 55, taxes due, but no 10%. So for those 4 years, you save the 10% penalty, but you got to retire. The problem in the solo 401k is, how do you do that, right? If you're self-employed, you own 100% of a business, and you're 55, 56 years old, if you retire, guess what? The plan's gone, right? So you might as well just close the plan and just move the money to an IRA and you're done. You're in the same position. You don't really need this rule. I've seen it a few times if there's multiple owners. Let's say there's 2 owners, okay? And one says, you know what, I'm gonna stop working. I'm over 55, but the other owner still wants the plan, so they'll keep the plan. But this owner needs the money, so they'll take the money if they're over 55, take advantage of the early retirement because they're leaving the company. But the solo K will still stay in existence because the other owner needs it. But generally for solo Ks, this rule doesn't really have much value, because if you're the only owner and you just are done, you want to do a rollover, just cancel the plan, right? Just terminate the plan and move on. You don't need to mess around with this 55 age exemption. So let's say hardships don't work, right? You're under 59 and a half, you're still with your job, you're under 55, you don't satisfy a hardship because it's a tough threshold to satisfy, but you need cash. What's your next option? Okay, the loan feature is the best option. It's way better than taking a distribution. Number one, your documents need to have the loan feature. Not all plan docs do, ours do. Not every company plan has a loan. Why? Because there's extra administration for the employer to deal with, making sure all the employees that do a loan are actually making the payments back. Even though you could kind of work through payroll to make sure that's happening, a lot of employers don't want to start chasing employees down, having to report employees for failure to pay, taxable distributions, and it causes some problems, headaches, and also some employers want to incentivize people to save and keep money in the plan to grow, so they don't want to let you pull it out. But if your plan allows for a loan, you can borrow 50,000 or 50% of your account value, whatever's less. So if you have 20,000 in your 401k, you can borrow 10. If you have $1 million, you can borrow 50. If you have 100, you can borrow 50. If you have 180, you can borrow 50. You can never go above 50. But if you have 60, you can only borrow 30. Okay, so it's 50% or 50,000, whatever's less. Okay, and it's a 5-year loan. It's not a balloon payment. It's interest and principal combined. Prime is now 5.5%, but it could go down if interest rates drop, as it's expected, as the Fed indicated recently. That prime rate's going to change. You also got to be aware of usury laws. So some people say, well, I'm going to use a 30% interest rate. Why? So the advantage of the loan is you're paying yourself back, right? If you take a $50,000 loan and let's say it's 5.5% interest, you're going to have an extra $6,000, $7,000 at the end of the loan. So after 5 years, that 50 grand turned into $56,000 or $57,000, depending on when you paid everything back, whether there was any early payments. So it's actually not a horrible investment if you think about it. I know it's not the S&P 500 this year, which is 15% plus, but there are many years, even last year, where the S&P 500 was not over 5.5%. It even could be negative. So in some cases, you're getting 5.5% on your money, and you're using it for any purpose. It's not a bad bargain. Solo 401k, if your plan allows for it, you can use it for any reason. Okay, anything. There's no requirements, so long as it's legal. You can use it to pay personal expenses, go on vacation, buy yourself a car, buy me a present, whatever you want, you can do. Okay, the key is you just got to pay it back 5 years, at least quarterly. You can pay it back weekly, bi-weekly, monthly, but the longest duration between payments cannot be more than quarterly. And the lowest interest rate is prime, which as of July 23rd is 5.19, is 5.5%. It changes based off the interest rate. So if interest rates drop, the prime rate will drop. Prior to mid-18, it was at 3.25% for about 12 years. It's only started to increase over the last few years as interest rates have risen, but it's still pretty low. So it's good because you can tap into your 401k, you get used to the money, you don't have to pay tax or 10% penalty, unlike a distribution, even a hardship where you still have to pay tax, no penalty. The loan, no tax, no 10% penalty. Use it for any purpose. Just pay it back over 5 years, at least quarterly, and you're paying yourself back. So that's the nice game, okay? You just can't go crazy, meaning you can't say 50% interest, 30% interest, because you have to look at your state usury laws, which is basically like loan shark rules. You can't violate those rules. So depending on your state, you generally can go above 10 or so percent. So for someone that has cash and they have good cash flow and they want to increase returns on their solo K, they can borrow $50,000 at 8%, 9%, and that's a pretty good investment, right? So you use the money. Let's say you use it to go on vacation, or I don't know, invest in a different deal, or pay off debt, pay off credit card debt that is at 20%. Now you're paying yourself back at 5% or 5.5% or 8% or 9%. You're paying off your debt at a higher interest rate, or even student loans. You are being able to pay yourself back, so your plan is growing by using that money, okay, which is a good investment for the plan. You're tapping into the money tax-free, penalty-free, and you're actually doing something you want with it. So it's pretty much a win-win. You're actually, with a distribution, the money's gone, right? You're not putting it back in. Whether it's hardship, equal periodic payment, you're taking the money out, it's gone. It's not coming back in. You can recontribute other money, but that money's gone. It's not coming back in. Yes, you're paying tax on it. Maybe you're escaping 10% penalty. Money's gone. With a loan, so long as you make the payments back, it's coming back, which is nice. So you're getting a good return and that money's coming back. You just got to make sure you pay it back. If you don't pay it back, you got to pay tax and 10% penalty if you're under 59.5, whatever's outstanding. So if you borrow 50 and you've paid 10 grand back, and then you just can't do it anymore because you're in some financial difficulty, you're going to pay tax on the 40,000 remaining and an extra 10% penalty if you're under 59.5. So beware of that. Some plan docs, depending on your docs, will allow for multiple plan loans. So you can start off with 10,000 or 20,000 or 8,000. And if you need more, just do another loan. This way you can control your interest. So instead of taking 50 all at once and paying 5.5% on 50, you can start with 8 or 10,000 or 12,000. And then if you need more in 2 years, 3 years, you're not paying interest on all that. So you have some flexibility so long as your plan docs allow for it. Okay, so these are just some of the great ways the loan works. And I've seen it used from a whole slew of different reasons. The popular ones are paying off credit cards, student debt, investing in your own business. But there's no right or wrong. It's your money. And that's what confuses people. People say, well, I don't understand. I can do a loan. Okay, I can pull this out of my IRA. Why can't I pull the money out of my 401k? I'm under 59.5. It's my money. Like, this is stupid and ridiculous. It makes no sense. But again, it comes back to the concept of the government, Congress, IRS, Department of Labor. They want to incentivize all of us to save, and they feel that if people have free reins to pull money out, they're just going to do it, and they're going to regret it in 20, 30 years. So we're going to try to protect you from yourselves, and that's what they're doing. IRA, they haven't, that policy hasn't trickled down to the IRA. There is the 10% early distribution penalty, which they hope is incentive enough to save, but they are allowing you to take it out. Whereas in the 401k, they're not allowing you to take it out unless there's a hardship, an equal periodic payment election, or you're over 55 and you leave your job, or you die. So unfortunately, the loan is your only other option. The loan is not available for IRAs, only for 401ks, and your documents need to allow for it. Okay, the loan has to be approved by the plan administrator. If it's a solo K, that is usually you, so generally not a problem. You're probably not going to deny yourself the loan. I have not seen that happen in 10 plus years, but who knows? You got to make sure your plan docs allow for it. Again, ours do. Not all plans allow for it, so just make sure. And again, make sure you can pay back the loan. Okay, do the math, run the numbers. We have free loan calculators on our website. There's plenty online. Plug in the numbers. I borrow 40 grand at 5.5%. I'm going to have to pay back X amount each month or each week or each biweekly or each quarter. Can I do it? If you can't, start with a smaller amount or don't do it at all, because if you can't pay it back, you're going to be subject to tax, and if under 59.5, 10% penalty. Generally, that's the issue now. If you miss a payment, now the employer is going to have to report you. Generally, they'll let you correct it if you miss it. Some will let you do it in the pay period, some in the quarter, some even up to the year. But you're going to have to work with the plan administrator on that to make sure you're allowed to correct any missed payments. There's generally no prepayment penalties, depending on the docs, but most docs I've seen have no prepayment penalties, meaning that you can take the money, 50 grand, and pay it back instead of 5 years over 1 year, 2 years, and there's no penalty. How can you take the money out again? So a lot of people ask this question. Okay, I'll borrow 50 grand. I'll pay it back in a year. Can I borrow another 50 a year later? There's actually a formula that tells us how much you can borrow at the same time. So if there's multiple loans, the loans in the aggregate can't be more than 50% or 50,000, whatever's less. So if you do 10 loans of 5,000, you're capped. If you have $1 million in your 401k, your max borrowed at 50. You can never go above the 50 at one time. What happens if you pay the 50 back? What's next? You got to look at what your value of the outstanding loan was 12 months prior, and then you minus that, and that's what you can borrow. So if you took $50,000 out, okay, so here's the example. You borrow $50,000 on January 1, 17, and on January 1, 19, you want to borrow more. What can you borrow? So assume you pay back $12,000 as of January 1st, 2018. You can take that $12,000 out a year from January 1, 18. Okay, so that's kind of how it works. So you got to wait a year from when that money's been paid back to re-borrow. So you can't just pay back 50 and take the 50 out the next day. In that case, you'd have to wait a year. If you pay back the full 50, you pretty much have to wait a full year. If you started paying back trickled month or quarterly, then you'd be able to take a year from that payment date, you'd be able to take that amount out again. So that's kind of the formula. We can help you with that. It sometimes gets confusing if you have multiple loans out there, but that's really the framework for the formula if you want to borrow money, how it works. Again, multiple loans. One thing of interest is if you have less than $20,000, you can borrow up to 10 grand. So if you have 10 grand, you can borrow 10, even though that's not 50% of your account value. they'll still let you take the full 10 out, which is nice. If you have 18, you can borrow up to 10, even though your 50% is 9. Once you're over 20, you're stuck at that 50%, 50,000, whatever's less. And it hasn't increased in many years. The loan, that 50K number hasn't increased. Will it? I don't see any incentive. Why? Because there's a lot of studies that show there are people missing loan payments. There are plenty of people defaulting on their loan, and I don't really see any incentive for them to allow people to take out more. Again, they want to incentivize all to save. So I really don't see that changing. It really hasn't changed in 25, 30 years, the $50,000 number, so maybe more. So we'll see where that goes. I don't see it changing. There's some new legislation, the Secure Act, which was a House-passed retirement bill. It has some IRA and 401k state provisions. There's nothing in there on the loan amount, so I don't think you're going to see any action on that at all recently or in the near future. RMD, so that's another way to get money out of your plan. But then an RMD requirement in distribution, you need to be over 70.5. Okay. The Secure Act, which I just mentioned, they want to push the RMD age from 70.5 to 72. The ERISA Act, which is the Senate passed legislation, that also has it pushed to 72. People are living longer, so I think that's going to happen. I don't know when. I think some retirement bill will be passed by will be signed into law probably the end of this year. I think there's consensus. It's bipartisan. People want to get this done. Just who knows when it will get done. There was a fast track proposal to get this signed, but it didn't. There were some senators that backed off for whatever reason. So it's not going to get fast tracked, and it's going to take longer to get passed. But there's consensus and bipartisanship, so I think it will get passed. The key provisions, RMD 72.5 for IRAs, they're going to let people make IRA contributions pre-tax past 70.5. They're for 401ks. There's multiple employer plan provisions. It'd be easier for multiple employers in different industries to bound together and use one plan document, one 5500 for their plan. So there's some interest in that. There's some push for annuity options on distribution. And of course, there's the limitation of the stretch IRA, which I'm not thrilled about, and I've talked and wrote about and spoke about. So we'll see where that goes. RMDs is about 3% of the value of your 401k you have to take in the distribution. And that's just generally how it works. The one interesting thing is Roth IRAs do not have RMDs. Roth 401ks do have RMDs. So if you're stuck in a 401k and you have a Roth, you should listen. There's a way to get around this Roth 401k RMD because Roth IRAs don't have it. So since you're over 59.5, you have a triggering event. You don't need to keep the Roth money in the plan. All you need to do is just roll the money from the Roth 401k to a Roth IRA prior to 12/31. So that on 12/31, your Roth 401k valuation is 0. So thus those 0 RMD because your value is 0, and you just roll the money into a Roth IRA, tax-free rollover. You're over 59.5. You can do it. You don't need a trigger event, and this way you circumvent the RMD rules. One interesting thing is anyone who's considered a 5% owner has to take RMDs no later than April 1st. Solo 401k, if you own more than 5% of the business, even though you're 70.5, you have to start taking RMDs. Whereas if you worked at Apple or some other company and you own less than 5%, you can defer the RMDs if you're still working. So if you're 70.5 and you're still working and you own less than 5% of the business, you could defer RMDs. Problem is for a solo 401k, most people are going to own more than 5%. So you're going to have to start taking RMDs in the pre-tax. There's no way of getting around that because the pre-tax IRAs also have RMDs. If Secure Act or whatever the retirement bill passes, I think you're going to see that 70.5 go to 72 for both IRAs and 401ks. So that should be in uniform. But in the Roth, you have a workaround where you can just do a rollover to a Roth IRA, RMDs. For pre-tax 401ks, if you own more than 5%, you're going to be stuck in the RMD world. Rolling the money to a traditional IRA will not help because you're still going to be subject to RMDs. If you own less than 5%, you can delay them until you stop working. So that's an interesting little quirk. Putting it all together, Getting money in your 401k is not as easy as you think, believe it or not. It's not your money until you're 59 and a half, unless you can satisfy a hardship, you're over 55 and you're retiring, there's a loan option, you take advantage of the equal periodic payments under 72T exemption. But other than that, you may not be able to touch it. If you don't have the loan, you're under 55, you don't want to do the substantially equal election, and you don't have a hardship, guess what? You're stuck. That money just needs to grow. It needs to stay in the plan. If you terminate your employment, you will have a triggering event. You need to then talk to your plan administrator to find out when you can access that money. You can always roll over money from a 401k to another retirement account tax-free, penalty-free. When you take a distribution, if you're under 59 and a half, generally tax and 10% penalty unless there's a hardship exception or equal periodic exception, or you're over 55 and retire. The loan, again, I think is the best option because you get tax-free, penalty-free use of the money. You can use it for anything you want, and the best of all, that money goes back into the plan at a decent interest rate of 5.5%, which is a decent return on your money, and you get tax-free, penalty-free use of it. And it's kind of I think, a mutually beneficial option because your plan grows because the interest goes back, and you win because you get tax-free, penalty-free use. If you can pay the plan back yourself 5.5%, use it to pay off credit card debt of a higher return or loan, student loan, I think that's a pretty good bargain for both sides. But again, make sure you can pay back the loan. There's penalties and tax if you're under 59 and a half, early distribution tax if you can't pay it back. So see if there's options for multiple loans, do the math, think about it, make sure it's something you want to do. Think hard before you want to pull money out. If you satisfy a hardship, think about, make sure you really need to, because again, usually when the money comes out, it ain't coming back in. Yes, you can make additional contributions, but it's hard to make up for money that is in there. The whole idea of compounding return, eighth wonder of the world. If you don't trust me, you can Google it. Warren Buffett said it. That's how rich people get rich, and that's how wealthy get wealthier. It's all about compounding return, having the money work for you without tax. So understand life happens. 2008, we all lived through that. 9/11, there's other things that happen. There's crisis in your life, medical things happen. I totally understand. I've had it, unfortunately. You just need to deal with it. Sometimes there's no better option than you just got to deal with the hardship. The idea is, hey, my tax rate is going to be 0. I got laid off. Who cares? I need the money. I got to pay my mortgage, my rent, my kid's school. I have no choice. I don't really care about a 10% penalty relief. Great, but my income tax rate's pretty much 0 because my income went from 80 to pretty much 20. So I don't care about paying tax on my hardship because my tax rate is going to be pretty much minimal. That's a fair point, and I respect that, and it happens, and that's why it's there. But just remember, it's hard to make up for the lost money. But again, if it happens, your family comes first. It's hard to worry about retirement 20 years, 30, 40 years down the road when you got to pay your rent next month, and that's totally fair and important, and something I absolutely respect. If you can do the loan, maybe look at the loan option. I understand if you're laid off, you're in some financial straits, paying that loan feature back isn't an option, and I understand that. Even if you borrow 20, 30 grand, you're still going to have to pay a couple $100 a month, and when you're struggling, that's just not going to work. That's the difference between food on the table or not. And sometimes the distribution is your best bet. Honestly, sometimes the hardship is just your best bet. It's there for a reason. There's nothing wrong with taking advantage of it. Again, you're going to have to prove that you need it, that it's a real and necessary hardship. And that's just something you'll have to deal with the administrator. But it does serve its purpose. The loan also serves its purpose in other instances. So there's a bunch of questions. I'll start with a few. If you use your loan from the 401k for your business, is the interest deductible? So the way it works is if you take a loan, it's a personal loan. So you borrow the money personally. So when you borrow the money, you have it in your name. If you then lend it to the business, okay, the business, the interest it pays you back is generally deductible. So the business, if you borrow 40 grand from your 401k, and then you lend the 40 grand from you personally to the business, and the business pays it back, it could be deductible. There's generally there are some limits about related party deductions of interest, but assuming that that isn't applicable, yes, the business can pay back the loan and get an interest deduction. So does the company get the interest on the 401k loan? So again, the answer is when you remember, you're the participant to the 401k. The loan is to Adam Bergman. It's not to Adam Bergman Inc. Even though Adam Bergman Inc. adopted the 401k, Adam Bergman 401k, Adam Bergman 401k is going to do the loan to Adam Bergman individual. Adam Bergman individual is the participant. I get the money, and then what I do with it is up to me. I can buy myself a Porsche. I could buy my wife a beautiful diamond ring. I could buy my kid all the baseball cards in the world, or I can lend it to my business, and maybe my business, when it pays the loan back, the interest will be deductible. The 60-month loan I was set up in 2017. Can you accelerate payment without any issues? Yeah, there's no prepayment penalty, so you can accelerate payments without issue. Yes, if you can do that, just make sure you can pay it back. So let's say your monthly payment is $500 and you pay back $1,000. That's fine. There's no penalty. You can keep paying more. You just can't pay less. Okay, and then you'll have less principal. Generally, you'll keep that same straight line, $500. You'll just pay off that loan over a shorter period of time. So instead of 5 years, it may take 4.5 years because you're increasing your monthly or quarterly payments. So that's generally how it works. I got another question. Can you do even a prohibited transaction with the loan? Yeah, you can do whatever you want. You can invest in your business. You can buy yourself a car. You're not subject to the prohibited transaction rules because you're borrowing the money. Again, someone asked usury laws. How do you figure that out? It's by state. So you look, I guess, at your residency, and then you can Google what the state usury law is, and then you can figure out the interest rate, and you should try to stay under it because you don't want to violate usury. I have another question about the hardship distribution. How much paperwork is needed to prove the hardship? And I think it depends on the type of hardship. If it's a house, the $10,000, I think you just need to prove you haven't lived somewhere for 2 years. I think for medical, I think you really need to show the cost, how much it's going to cost, and really probably going to have to show bank account statements, financial statements, show that your bank account, this is what is in the bank, this is your investment. You may have to do a financial profile, financial statement to show, hey, I have a net worth of X. I have $300 in my checking account, $1,000 in my savings account. I have stocks of $400, whatever, and I need $40,000 to pay for this medical expense. I think based off that will help determine the administrator determine whether the expense is necessary and whether the hardship applies. So nothing wrong again with taking a hardship. You just need to make sure you have the supporting documentation to support the necessity of taking it. So I think I'm going to end now. Adam Bergman, IRA Financial. Thanks for listening, watching. Again, if you have questions on taking a distribution, borrowing money from your plan, we're always here to help. It's important to understand the triggering rules that you have, plan triggering rules. You can't just take money out of the plan when you want. There's hardship exceptions. There's a 72T exemption for substantial periodic payments. You also have the over 55 and retire exception. You have the loan feature exception if it's available. Then remember, you got to deal with RMDs and the rollover rules. Once you're over 59 and a half, you should be able to get access to your money and roll it over to an IRA or other retirement plan, tax-free, penalty-free. Under 59 and a half, you're generally not going to be able to do a rollover. If you leave your job, you got to look at your plan docs to see when you get access to your money for rollover purposes or distribution purposes. It could be immediate and up to 12 months I've seen. So just going to be available, aware of what the plan says. Adam Bergman, IRA Financial. Thanks for watching, participating, listening. Until next time.